of speakers. Bellona Foundation is really excited about our partnership in the Global Climate Network, which constitutes, and I'm going to present this report today. I will leave it to Andrew Light to explain a bit more details on it. And then, of course, Ketil Lund, who was the main sharper, who did all the hard work for Jens Stoltenberg in terms of preparing the high-level advisory group report. I hope you enjoy this little session, and I will leave it to Andrew Light to continue.
Great. Thank you very much, Sven. So, my name is Andrew Light. I direct international climate policy at the Center for American Progress in Washington, D.C. And I'm extremely pleased to be here this afternoon with all of you, and thank you for coming for this session on the report that we released in November, Investing in Clean Energy, How Can Developed Countries Best Help Developing Countries are doing enough help to other developed countries. So how can developed countries help developing countries finance climate-friendly energy investments? The Global Climate Network is a group of 8 think tanks around the world. We've been working together for about 2 years now. This is our 4th report. The funding for this report is from the British government, from the Foreign and Commonwealth Office. This is the next to last report. We'll do one more with the contract we've had from the FCO to do work really not focused on the negotiations, but focused on the global green economy aspects of climate change and the problem. You'll hear more detail shortly about the contents of this report. Clearly, any work on international climate finance this year is sort of in orbit around the AGF report that was released in November. And in that respect, we are also, in this report, in conversation with the content of the AGF report. We duplicate some of the work that they did, that my colleague Richard Caperton will explain later. And in terms of assessing different risk assessments on different mechanisms that can be used to achieve the $100 billion annual goal set forth in the Copenhagen Accord for a climate fund. But then we add some things that are not included in the AGF report just simply because it was not in their mandate. Specifically, and I think this is probably one of the most interesting things that we'll hear about today, is we have 3 country studies, India, China, and Nigeria, and we try to assess exactly what in fact you could do with sufficient climate financing in those countries with respect to creating a low-carbon development pathway. And I'll briefly introduce our speakers, and then we'll start the program. So we're going to start with Ketil Lund, who is the State Secretary and Deputy Minister in the Norwegian Ministry of Finance. He worked actively on the AGF report with President Stoltenberg, who co-chaired the AGF. And then after Minister Lund, we'll go to Richard Caperton, who's a policy analyst at the Center for American Progress.
And the broader NGO community does. It's really impressive. You combine this engagement with professionalism, and I think that's, although as a politician you could criticize, and sometimes you feel it's a little bit unreasonable sometimes, but I think at the end of the day, we all think you do really make a difference in the way what you do. Now on the AGF, most of you might know this, but let me give you a little bit of context first. The starting point, I think, is the Copenhagen Accord, paragraph 8, which basically says that in the context of meaningful mitigation actions and transparency on implementation, the developed countries committed to $100 billion a year by 2020. That's the starting point. Now, the Copenhagen Accord wasn't very explicit on how to mobilize that money. It said some things, however. It said public and private, not public or private. It said traditional sources, innovative sources, blah blah, but not very specific stuff. So in February, the Secretary General established this high-level group, and it to give an advisory group to give him advice on how to mobilize these resources, to develop practical proposals on how to do that. And the group consisted, and this is very important, the group consisted of a combination. It wasn't only politicians or only academics, but it was this combination of world-class expertise, Nick Stern, for instance, and high-level politicians in office now, with responsibilities now, from all the key countries, both developed and developing countries. US, China, India, so on, Brazil, South Africa. And I think that's important, that combination, because it would be easy to have some academics write a report on how the way forward. You know, do that in a week, or half an hour. But but this combination of expertise, politicians in office now, and the private sector perspective, third different perspective, is a combination. And the fact that this group came to an agreement that pointed out the way forward, not a very concrete receipt, but a way forward on how to mobilize these resources within the next 10 years. I think it's a major achievement. I think it's important. So that's my first talking point, my first message. The group concludes that, as I said, that it will be challenging, but it is feasible to mobilize these economic resources. There is, however, no silver bullet. There is no one single solution. We'll take option C. We'll do that. It will require a combination of scaling up of existing instruments, existing public instruments, development of new public instruments. We need to develop new public instruments within the next decade, and also to enhance or increase private green investments in the developing world by 2020 to achieve this goal. And I'll point at three of the new public sources that are highlighted by the group. First is new carbon taxes and auctioning of allowances, which may mobilize around $30 billion annually by 2020. That's not money. That's 1/3 there. So that is maybe the one single instrument that can mobilize most or provide most of the revenues. And then the group also points at the importance of putting a price on emissions from international transport, shipping and aviation. That might mobilize around $10 billion annually for climate action in developing countries by 2020. And the third point I'd like of new instruments that I would like to point at is the removal of fossil subsidies in the developed countries. That might mobilize $8 to $10 billion as well. A lot of money, significant. If you add these sources, you're halfway there. But as you see, the three instruments I mentioned now, they have one very important feature in common. They're price-based. And that is a general or overall very strong conclusion from this group. We do need to put a price on carbon emissions. That is, and the group said we need a price in the range of $20 to $25. That depending on your perspective, that's a lot, or that is not a lot. I think the Nick Stern report says we need a higher price, but it's high compared to the current European price. But it is, I think, in the range of the EPA estimates for 2020. So it's in that range. Why is carbon pricing so important? When my Prime Minister talks about this, he says that carbon pricing has a double positive climate effect. And I'd like to double that. I think there's double of the quadruple effect, positive effect. First, take the first traditional effect that he also always mentions. Carbon pricing does represent a huge potential source for raising revenue that can be used for climate actions in developing countries. That's the first one. The most important one in this context, yeah? But additionally, it does provide a strong incentive for reducing emissions in developed countries. And in order to solve this problem, we need to do both. It will not, look at the numbers, it will not be enough to reduce emissions only in the developed countries. It will not be enough to reduce emissions only in the developing countries. We need to reduce emissions all over the place, basically. And carbon pricing provides an incentive to do both. That was the second reason, two left. A long-term price signal, I think, is the key driver for development of climate-friendly technology. And I think that's particularly important in a Bellona context, but you're very into the need for develop more and make use of climate-friendly technology. That is, if you get a long-term, strong, credible price signal, I think you'll see massive. Technology takes a while to develop, but within a few years, you will see a massive development of new, more climate-friendly technology. I think that's a very important feature or aspect of carbon pricing as well. And the fourth thing I want to underline, that's a little bit more complicated to explain, but carbon pricing decentralizes the decisions on how to actually reduce emissions. It leaves the decisions on how to do it with the ones who know best how to do it, be it private consumers or companies with the technological know-how. The politicians make decisions on what the price should be or what the cap should be, but how exactly to do it is left to the ones who know best how to do it. And I think that's very important, because I remember at the Copenhagen conference last year, Bellona had this very impressive 1,000 solutions to the climate problem or something.
Only 100.
100, okay, yeah. But there are 1,000. I mean, 1,000. I mean, yeah, and that's very important, because if we are, there are so many very different measures that need to be undertaken in order to solve this problem. And the politicians don't. And what's sensible to do today might be outdated tomorrow. So if our policies are based on that the politicians are always updated and make this and that specific regulation, it won't be an efficient way to approach this problem. It's better then to decentralize, for the politicians to say, look, we want this cap, or the reductions to be this much, or the price to be this and that, but we leave it to you how to do it, because really it doesn't matter how to do it as long as the emissions go down. And I think that's a very important aspect of this as well. So carbon pricing is key. So that's if I were to point out one conclusion from this group, it is that it's two. Challenging but feasible. Three. Challenging but feasible. No one solution, combination of sources, and carbon pricing is an overall key tool. A tool. It's not the only tool, but I think it's very hard to imagine that we get to solve this climate problem if we do not use actively carbon pricing as a tool. So just finally, with respect to the negotiations, the report has been well received generally, I think. Well received. The G20 meeting in Seoul welcomed it and asked their ministers of finance to consider it. ECOFIN did the same. And it's also been submitted into the negotiations here. And I guess those texts, change from hour to hour, and I'm not updated. But it is, and I hope it will be valuable in the work towards Durban on how to actually mobilize the 100 billion. I don't think that will happen here in Cancun, but hopefully we will agree here in Cancun on a process on how to actually mobilize these resources, and I hope our report can be of value in that work. Thank you.
Thank you very much.
Thank you all for coming.
I'm Richard Caperton. I work at the Center for American Progress on energy finance issues. I know it's a busy day out there and there's a lot going on, and it's great to see a full house here talking about what is clearly an important issue. I think the Advisory Group on Finance report does an excellent job of describing not only options for addressing the issue, but really stepping back a little bit and talking about why this issue is so important. This is the opportunity for investment. This is how we're going to drive investment in clean energy, and describes it as an opportunity. And I think your Prime Minister does an excellent job of describing it as an opportunity and not a cost on the world. Could not agree more with that. So in the United States context, when we talk about public finance, I've been thinking about what's in the advisory group report and how that would work in the United States. And clearly it's going to be challenging. Feasible, I don't know so much in the U.S. From the public side. You have to think that in the U.S. there's the debt to GDP ratio is above 70%. Congress isn't going to approve any more spending. There's significant opposition to a financial transactions tax, opposition to using special drawing rights from the IMF. Bunker fuels is possible, but I think there are challenges there. And I'm the world's biggest believer in a price on carbon. But directing that money to international finance is going to be really tough, especially at the levels that the advisory group report calls for. But there are options in the U.S. Clearly, there's bunker fuels. I think there's other international development contexts that's going to be used for public money. But the reality that I see in the United States and in many other developed countries is that we need significant private investment. And I think the advisory group report does a great job of pointing that out. And I appreciate that they don't specify an amount of private investment, but it's clearly needs to be significant. So when I think about how to drive private investment, I think that's sort of what our paper is about. And I was wondering, well, how do we do this and what's a framework for doing it? And clearly where I come from is that investors will put money into profitable projects. That's what they do. And so the challenge then is making these projects profitable, making clean energy investment and climate investment in developing countries a money-making thing for private investors. There's a lot that you can do there's a lot that goes into projects being profitable. There's technical options, there's having infrastructure in a country, there's the alternative fuel sources. Profitability of solar depends on if it's replacing diesel generation or natural gas generation. There's operational expertise, and then I think there's also financing that is a huge player in that, but I want to emphasize that it's only one aspect of profitability. But that's clearly a huge part, and I think that the Copenhagen Accord recognizes that. The $100 billion is going to go a long way towards doing that. So in thinking about the financing aspect of it, my job in this paper was to propose a few mechanisms that could be used to leverage private finance. We're going to get some amount of money from the public side, and then what should we do with that money? And how is that money best going to drive private investment and leverage private capital? So we came up through some research and through a series of interviews with experts in developed and developing countries with 5 different mechanisms that we could use. It's not a definitive list, but I'm going to talk about those. They do 2 things, each of these. They make capital available in places where there was actually no money flowing. Money would flow given these instruments. And 2, even in places where the money was flowing, it lowers the cost of capital, which makes projects cheaper, thus, of course, increasing their profitability. I apologize in advance. Some of my next few minutes is going to be a little bit technical, but I'll do my best to make it simple for a lay audience to understand. I think that the GCN report is directed towards a lay audience, and clearly the advisory group report is. But experts wrote it is very digestible for a lay audience, and should be commended for that. So we drop these mechanisms into 2 different buckets. There's the debt side. This is what we think is provided by banks primarily. They just invest money and then get paid back over the course of a long time. And then there's the equity side, which implies an ownership stake for the investor, riskier investments, so they get paid at a higher level. This is going to come primarily from, say, private equity investors, sovereign wealth funds. It's going to come from the actual like owner and developer of a project who put their money up, very similar to, say, the down payment on a house. These are covered more extensively in a companion piece that I wrote that's available on the GCN website and CAP's website. It's called Leveraging Private Finance for Clean Energy. I'd be happy to talk about that report with anybody too. But so on the debt side, we come up with three things. The first is a loan guarantee. This is where a borrower gets money from a bank or a private investor or private lender, and somebody, say in this case the climate fund that has $100 billion, says we will pay back that loan if the borrower can't pay it back if they default for some reason. This is useful in areas where there's a whole lot of different types of risk, where there's sovereign risk, there's political risk, contract risk, technological risk. The loan guarantee will manage all of that. And it's also widely understood. Your export credit agencies use it, your development banks use it, private banks do it. There's a whole market for it. The second thing that we talk about in the report is policy insurance. This clearly addresses the risk where a project is profitable because of one specific policy, and if that policy disappeared, it would no longer be profitable. Something like a feed-in tariff would fall into that. And the climate fund could provide insurance. Now, this is a little bit tough to price. Pricing a loan guarantee is pretty easy to do. Not easy to do, but people know how to do it. Policy insurance is a little tough. I propose a mechanism in this Leveraging Private Finance report that I'm happy to talk with anybody about, but I think it's going to be really hard to figure that out. That's probably the biggest challenge there. And the last of the debt instruments that we talk about is something that I call a foreign exchange liquidity facility. That's sort of a mouthful. But what that does is, in an investment where say a developer in Brazil is building a wind farm or solar panels or a hydroelectric facility, they will get paid for their electricity in reals. However, if they have a loan from Climate Fund, it would not be operated in reals, most likely. Or if they get a loan from an American bank, they're going to have to pay back the loan in dollars or some other currency. So if the exchange rate fluctuates significantly, they may not be able to pay that back. The liquidity facility operates like a line of credit, and when the exchange rate goes to a certain level, then you can draw on that line of credit and then repay it when the exchange rate gets better for you. So those are the debt side. On the equity side, we talk about two things. The first is something that you could think of as a pledge fund. Now this is where big investors, private equity funds, sovereign wealth funds, don't want to deal with $500 investments, $1,000, $10,000, even $500,000 or $1 million investments. They like much bigger things, and because the transaction costs on these are pretty big. Something that we could call a subordinated equity stake, and this is where equity investor would get paid back before the climate fund. So if you need, say, 40% of the cost of a project to be paid with equity, an equity investor could put in 20%, and then the climate fund could also put in 20%. And that would get you to the 40% and make the project work. So that's just a little bit of what we talked about in the report. I don't think it's the most interesting part of the report by any means. I think the most interesting part of the report is how those mechanisms would be used in the developing countries. We do a little bit of calculation in the report and identify that these mechanisms could leverage anywhere from 2 times to 10 times the amount of the public investment in private dollars. I think that's in line with what the advisory group talks about. And I think I'll just hand it over, but Ewan and Manish can talk about how that would be used in the developing country context.
Thank you.
Thank you.
Thank you. Ewan.
Yeah. Three quick points from me on how we experience this from a Nigerian perspective. The first point is about scale. The scale of the financing needs, the financial requirements. What is the scale of the capital costs? If we are targeting a transition, say in the energy sector, as our report focused on the transition to clean energy. Even for a relatively smaller economy like Nigeria, we will be talking about an investment cost about 33 billion United States dollars for only small hydro alone and some elements of gas generation. Well, gas because it's replacing diesel, which is much decade fuel. And Manish will talk about India, but China is about over 100 billion United States dollars in capital costs alone. And in the rest of the developing world, I think studies are saying about $500 billion, 500 or 500 and something billion United States dollars. So just to give you a picture of the magnitude of financial requirements that are needed to be able to begin that transition that we are talking about. So it is significant. So within that context, if you now negotiate for countries like ours, and you look at that sheer size, and that is only for mitigation alone, we're not talking about adaptation costs, which is quite significant, which might run to about 100 billion, according to World Bank estimates. So if you now look at this big elephant in the room and engage in discussions about how to raise 10 billion United States dollars over 3 years, 2010 to 2012, you begin to get a kind of chilling feeling that you have in the corridors, in the negotiation corridors. The gap between even pledged and the requirement is extremely huge. Now, I'm not saying that 10 billion or 100 billion is small money, but I think, which is really my second point, that it can play roles, different roles in different categories of countries. For the least developed countries, that kind of money can make some difference in actual investments, not only paying for incremental costs, because often in some of these countries, you don't really have a huge incremental cost, because a lot of the investments that needs to be done really makes good economic sense. So they have actually negative incremental costs. So actually what you'll be investing in is market development, say for cook stoves, for solar energy, for small hydropower. So you'll be investing in policy development, in some finance, and some other areas. So it does make some direct impact. But for countries like ours, India, China, I don't want to put Nigeria in the same basket, it's the big ones. But countries like ours, we need to be innovative, need to be creative to see how international climate finance of that magnitude that we're talking about within the framework of the negotiations can make a difference. And Richard has enumerated a number of those areas. And just quick notes on what we think can work in mobilizing private finance in Nigeria. For many countries, for countries in our category, like Nigeria, there is a lot of uncertainties out there in the Western public about stability in policy frameworks, for example. So where some kind of policy guarantees can be useful. The World Bank has experimented on a loan guarantee for the gas sector in Nigeria with $400 million United States dollars portfolio. That possibly helps. It's also possible, like for us in South Africa, that some work on some special intervention funds going to feed-in tariffs, for example. can be extremely helpful in the electricity sector, where the gap, where the gap in costs that are passed to the consumers and that what the companies receive are significant. So there are all those areas. But let me just quickly say that even though there are so many of these tools out there, I think it's very important, especially for smaller countries, that this is linked also to mainstream development activities in those countries. And that is the only way you can mobilize domestic political support, and especially African countries who have other things on their plates, to engage in the process. It is where you increasingly link it to key development financing, inclusive of ODA, inclusive of aid. So I sometimes don't think it's very helpful that there seems to be that there's this lack of integration, this lack of stronger linkage between a low carbon investment process and mainstream ODA. Yes, the whole issue of additionality and so on play a role in that, but for smaller countries, that would be important. And just my last point. For countries like Nigeria, and this is our experience, the bulk of financial requirements in this transition will have to come from domestic sources, now and in the foreseeable future. Domestic financial market will play the most important role in doing so. It goes back to the first point about scale, too. You know, how much of international finance, you know, in the various categories, how much can be anticipated to be able to fill the financial gap there. So, but in countries like ours, the domestic financial market is very important. So I think that one of the critical things that we need to do is to see how do we incentivize the domestic financial market to be able to process, understand the new low carbon economy, be able to do due diligence on requests from investors for funding, build capacity for that transition, and so on. So then again, lastly, you know, policy is having a policy framework that is supportive, not in terms of financing at all, but so that's supportive for the growth of low carbon investments. And these kind of policies are not necessarily financial, but do you have policies in place that allows the private sector to invest in hydro or small hydro in your country? Is the whole supply side dominated by the government, for example? So if you don't get the policies right, like in my country, there will be little projects to finance at all. So somehow I think that it is important that we look at it in a broader scope. Because if you don't get the domestic policy frameworks right, there might even be little projects to and we see that in the carbon markets in CDM in Africa. You know, that you needed some kind of stronger incentives from other sectors, maybe manufacturing, maybe electricity and so on, to be able to create the basis to be able to engage in the carbon market, and then stop there.
Thank you. Thank you.
Well, the one risk of being last speaker is this, that you come with your story prepared, and then you hear the speak, and then you keep engaging with that while you're listening, and then you want to pick up on many of the points mentioned there, and that actually puts you into a very kind of chaotic situation in terms of your articulation. But okay, so what I will do then, I will use whatever has been said. I'll make 3 points to set the context, and will stick to my story. Now, 3 points. One, building on what Eva just said, the question of scale. Now, in our study from China, India, Nigeria, and South Africa, solar and wind in Nigeria, China, and South Africa, and just solar in India, the policy targets that are there till 2020, the capital cost has been estimated to be more than 660 billion. That means, on average, more than 60 billion every year. These 4 countries and these very specific sectors for very specific policy targets is needed. Now, if we think of that, like 60 billion every year in these 4 countries, in this tiny area of investment needed, and compare it with the 100 billion commitment by 2020, then it sets a context. Like, okay, how do we deal with that? And then also further, as is mentioned, that even that 100 billion is challenging, but feasible with lots of political caveats mentioned in the report itself. That how it, taxing aviation and maritime. I mean, it's easy to say, but when we think of how to operationalize it, it's really scary. So that's one point. The second point is why finance is so important, and why immediate finance is so important, is basically in the context of the kind of technological transformation that is needed to meet the climate challenge. Now, the technological transformation is a very interesting thing. It anyway happens, right? You need renewable energy, you need energy efficiency, and you need change in practices. That is already happening. You can see the trend. There is a lot of talk around. The governments are coming up with policies, and then private sector is also coming forward. But the challenge is to make that technological transformation happen right now, and that's where the urgency of money comes in. And then the third point, I just want to paraphrase what the Prime Minister of Ethiopia had said yesterday in a side event that presented the report, that developing countries are not really concerned about how you mobilize the money. For them, the question is how it is going to be distributed, and then further how it is going to be utilized. Now, it is in this context that we set out to explore options for the GCL research. Now, if we look at the question of technological transformation, there are basically 4 key elements that one needs to look into, and that also emerge from the various interviews and stakeholder consultations that we have had over the last 2 years. It's not just this report for finance, but the preceding reports that we did on potential of green jobs, as well as barriers to technology development, diffusion, and transfer. So those 4 key elements are: there is one investor, there is one financial, and then there is one consumer, and all these 3 are linked and operate within a larger system, which is, I would like to call it a financial, economic, technological and market infrastructure that connects these three actors. And very quickly, investors face two major risks, two major challenges. The projects are risky. B, upfront high upfront capital cost. But financiers, but I'm speaking from India on this point particularly, the commercial banks in India, they have two major problems. One is there is a hell lot of perceived risk in putting money into these new kinds of projects. And then many of them even lack technical capacity to analyze the kind of commercial and financial viability of projects. So they go by a standard practice of analyzing creditworthiness of investors on the basis of their balance sheet. What they fail to recognize that many of the energy efficiency projects can even improve the balance sheet of those firms. So that's a challenge there. And from a consumer point of view, whatever you are going to produce, let's say power, then the consumer has to have a purchasing power to buy it. So if the price that you are going to sell it is higher than the price that comes from other sources, it's not going to be attractive to consumers, and anything that is not attractive to consumers is not going to be attractive to banks or investors. And then some of the problems are because of systems. So there are lack of infrastructure, so you have these segregated markets, lack of competition, and so on and so forth. So what we need is, the money is needed primarily, this comes out from our interviews on what 5 mechanisms that Richard just spelled out. When we went to various stakeholders in India and asked, like, how do they perceive these usefulness and significance of these 5 instruments, then it comes out that these are the areas that any financial mechanism must address, and that's the only way. Now, so I'll come to some very quick points. Well, before that, let me say that one thing that comes out very clearly, that all these instruments were considered that they are really useful because they seriously address the perceived risk issues. With very less actual investments, they can build trust and confidence among investors, such as loan guarantees. They are really big in terms of building investment and building confidence among investors. But the real problem is that there is a commercial viability gap because of high upfront cost. And unless and until that gap is met, these instruments will have a very limited impact. Now, let me give you an example. Recently, Terry did a study on carbon budgets, saying that, okay, if you forget whatever happens till 2010, and we allocate the available carbon space among all countries on an equal per capita basis, then what does it mean for India? And it comes out that India will need to transform its energy sector and transport sector substantially, and the incremental costs are going to be up to 14 trillion for over the next 4 decades. Now, that is the total budgetary support that one can, that India is expected to provide to overall economy. That, you know, that's the total budgetary allocation one expects for next 40 years. Now, so that's big. But then, very recent example, India's national solar mission, which sets a target of achieving 20 gigawatt by 2022, and it announced many generation-based incentives, and the cost of which has been estimated to be about 15 billion over next 20 years, and which is to be mobilized through domestic sources and renewable energy cess on coal production and import has been introduced to finance that. Now, if we look at that, the impact of it, it's really an amazing story. The 11th 5-year plan in the beginning, and at the end of 2007, had introduced rupees 15 per kilowatt hour of feed-in tariff for 12 years. It didn't generate any significant momentum among the investors. But this year, when the annual budget introduced the, well, before that, when the feed-in tariff was introduced, and that is going to be minimum for 25 years, along with renewable purchase obligations, it creates a market for renewable energy. It's important to note that for the first phase, that is till 2013, the target is just 1 gigawatt. But the applications and the proposals that the government has received, there are 450 proposals totaling 5 gigawatts. Now, so that tells us that how, when you fill in for the commercial viability gap through policy intervention, that could actually generate more dynamism, and it also tells, like, private money is out there. You just need to direct it through market creation. Now, it is in that context that the limitation of these 5 mechanisms is that they don't necessarily create market. So their effectiveness is only till the point that there exists a market. So that's one point. And then there are 2 other examples that for developing countries, the real challenge in terms of energy and emission reduction is that they have to provide basic electricity and power to a large, huge rural population which doesn't have access to electricity. Now, these mechanisms, and that's an area where private investors do not go. Or whatever is happening is being done by either governments or through NGOs, such as like Terry has this campaign, Lighting a Billion Lives. So far, 576 villages have been lit up by that. But the experience is this, and then there are some other programs in India that DFID runs. The experience is that in the absence of grant, these projects are just not possible. Now, this is one area, and this throws up another question, that in terms of how we use money, for rural electrification or for areas where consumers don't have purchasing power, any instrument that relies highly on leveraging is not going to work, at least in the immediate future. Once there are investments and then those technologies are cost effective, in maybe 10 years' time, it could leverage more. But to start with, to meet the major challenge, the grant investments are very important. And I think it is in this context, I mean, I had few issues with what the AGF report says. Of course, I understand the political limitations, and within that, it is really very great and optimistic document. I had many issues, but then some of them were clarified yesterday. But still, there's this point that the AGF report relies on the leveraging factor of 2 to 4, and that reference comes from all World Bank and Clean Technology Fund kind of investments. So they are real investments where there is a profitability involved. Now, so in cases where this profitability is not involved, that is something one needs to be very careful about and thoughtful about it. And the other point which becomes clear from the example of solar energy, that solar mission in India, that if you support policy, then the leveraging factor could be even higher. So, and that brings us to a second point, that a substantial part of the, I'll just take 2 more minutes, is that okay? Yeah. Substantial part of the 100 billion mobilization relies on offset revenues at 30 to 35 billion. Now, market offsets, I mean, they are, on the face of it, they don't really support policy expenditure. So these are the points that one needs to think about, and I think that's what it is. And one last point, that I don't know if the leveraging works when it comes to investment and expenditure on adaptation projects. That is a big question that I have, concern I have, and thank you.
I'll go ahead and start. Thank you for all the presentations. It was really interesting. I haven't read the report yet, but I'll try to get through it. I'm not very technical on the finance side, but a question for you on the 5 mechanisms that you were explaining. You were explaining them in the context of a global fund. So clearly that is an issue within the negotiations here. Is this something that you're advocating for here in Cancun, or an issue for Durban in regards to these
Sure.
kind of policy mechanisms? And the second half of that is, do you have any traction, with any negotiators that would put forward a proposal?
So I'll look to Andrew for any traction with negotiators. The negotiations here are not at that level yet. I don't think that it's appropriate to talk about specifics of what the fund should do. I think it's more about the fund can do these things. And if you create a fund, I think it's almost certain that based on the advisory group report and what we see in other international finance mechanisms, that they will adopt tools like this. And I think that what we do in the paper is say what these tools are and why they will be useful. Is that helpful?
Let me say one thing, and then I actually want to turn this into a question for Minister Lund. In terms of of course, we're a U.S. organization led by a prominent political figure in the United States, John Podesta, so our relationships are most closely with the U.S. delegation. And what we did to prepare for this report is not aimed at necessarily influencing this forum. We produced a separate report with the Alliance for Climate Protection called U.S. Role in International Climate Finance, which was targeted at our delegation. And it's a report that we did with analysis by Project Catalyst and climate advisors. And basically what we sort of argue for is that in between the end of the Fast Start financing in 2012 and the beginning of a $100 billion annual fund in 2020, we need to start building a ramp-up period to go $10 billion a year until 2019, hopefully, and then jump up $90 billion seems kind of unlikely. So let's start building on the Fast Start financing. So we focus on the 2013 to 2015 period, and quite improbably to many of your ears, I'm sure it will sound, we sort of say, and the U.S. should take the lead on this. Now that is part of our sort of political philosophy, which is that we believe that the strongest defense is a good offense. And so rather than sort of only being defensive against what we expect will be a more recalcitrant American Congress starting in January on these kinds of issues, we want to actually put a proposal out there that's actually viable. It's entirely consistent with the analysis that was done in this report, in the GCN report. We talk about mobilizing $30 billion annually from public funds or a carbon market between now and 2015, and $70 billion annually in private investment to put us on a trajectory to hit $100 billion and also achieve the needed clean energy investment projects, mainly in developing countries, to keep us on a 2-degree C pathway. Now, this is where I'll bring it back to Minister Lund. What really made this report possible, in addition to the good folks we work with at the Alliance for Climate Protection, was that we were able to get some of the McKinsey data that was prepared for the AGF report that did not make it into the report. And so I know that you can't speak completely freely, obviously, about the discussions over that, but do you think that, in a certain sense, how happy were you with the scope of the AGF report in light of the potential directions that it could, and where, and maybe a more politic way of putting this, a more diplomatic way of putting this, what do you see as the next important questions that the international community needs to make on top of the AGF report? We've discussed some of the next steps, including country-by-country analysis, but what do you think are the next important steps beyond the AGF report that we really need to dig into and agree to try to answer as we set up the climate fund?
I think when you look at the sources, the potential sources described by the report, some of them are clearly domestic sources that the implementation of them will depend on national governments. And so they're kind of sources that won't be implemented in the context of a UNFCCC negotiation necessarily. Others have a more international character and can only be implemented in a broad international cooperation. The one that springs to mind is international aviation and shipping. So I think to move forward actively on the ones that need all these areas, but maybe especially on the ones that require international cooperation. And I mean, someone said that it's easy to put down a piece of paper that we need a price on carbon and international shipping. Yes, it is. It's hard to make it into reality. Having said that, I don't think we've had before an agreement between key politicians from all these countries that, look, we need to do this. Yes, there are unsolved issues, practicalities, but this is, within the next decade, a thing that we need to get in place. Look, we're not going to mobilize these resources by, Easter next year. So there needs to be a trajectory. But so I think we have to appreciate that these things are difficult, but I think also, I hope at least, that this report has narrowed down the options, come up with some figures that make this whole discussion, this conversation more serious or more narrow down the options and hopefully move these very difficult but also very important conversations hopefully a substantial step forward. And with reference also to the question about the leverage factor. And that might be questionable, I don't know. I think the fact is that how exactly the world looks like in 2020, it's hard. I mean, we're living in a changing world. So it might be there's a figure here that shouldn't be 2, it should be 1.5. But I think, you see what I mean, or 1.8. I think we have to acknowledge that some of these assumptions, calculations are uncertain in terms of none of us do actually know what the world looks like tomorrow, let alone 10 years from now. But I think what we've done now, we have reached a consensus on these rough assumptions are, in the right ballpark. And they're agreed by this group. So I think that can be helpful. I think that's the thing we should focus on, not whether it should, this figure should be 1.7 or 1.8, if that makes any sense.
Thanks everyone. Sasanka Zuri, also from Terry. And just building off on what you said, Minister Lund, and what Manish said, and I want to focus on a specific with respect to the shipping and maritime, because I find that fascinating in that, given the spread of countries that were part of the AGF report, that there was generally a consensus that this is something to go down on, because it's a fascinating thing with respect to non-Annex 1 burdens that can be passed on onto developing countries. So I was wondering if you could just comment on that general acceptance, given that there is a strong aversion. I'm just looking at the 2 recent CRP texts of the LCA right now, and I hope it's not a typo, but the entire section D has actually been removed, which is all about the IMO shipping type sectoral activities. I don't know if that's just something I've just missed, like section 2, CRP2 and CRP3. CRP3 just came out, and that whole section is no longer there. So I think that somewhat speaks to a little bit. So I'd be curious to know just how that general consensus sort of translates a little bit into the negotiations on shipping and maritime, given those non-Annex 1 concerns, I guess.
I'm not very updated on the negotiations themselves, but I think it's as I said, this is an area where there are a lot of work to be done, and in the report itself there are different views on which road to walk down in order to establish it. Should it be UNFCCC, should it be IMO? But I think, as I said, I think it's an important step forward, just that we agree that we need to get something done there. And obviously, as I said, this is an area where we need to. I think our position, the Norwegian position, which should be that this should be sorted out within the IMO context. And what is important also is that from the mandate, from this whole, from the Copenhagen Accord, is that there should be no incidence on developing countries. Now, obviously, this is one of those potential sources where you have to be careful about that. Yeah.